But to start off, the action in the Hong Kong dollar um, really takes center stage and should be considered the center of the action. So if you have been following along, starting last week, I've got two snippet articles here. The Hong Kong Monetary Authority, the HKMA, which kind of operates or maintains this dollar currency peg that Hong Kong operates as kind of the main intermediary between Western trade and the Chinese mainland. It's really the mirror image of shipping and goods that are the subject of all the headlines we're seeing in the tariff. Right at the end of the day, what you see going on in fixed income, interest rates, exchange rates, FX, the dollar, the mirror image of that is global trade. And so, this what we saw in the last week in the development in the Hong Kong dollar is really kind of the point to watch as the key kind of flare up for this tariff phenomenon. So if you roll back the tape, I don't know if you tuned into us for a couple of weeks in a row, or my appearance on the podcast with Nick Bhatia last week, where we talked about this. But what the tariffs actually represent from a financial standpoint is kind of a closing off of the US dollar in terms of flows from trade to the rest of the world. So in Hong Kong, where ultimately all of the financing settles out, in the skyscrapers around the harbor, where all of your global money center banks kind of have set up operations. That's where the dollar transactions for, let's say, the US is importing, goods that wind up on the store shelves at Walmart or in your cardboard boxes that show up on Americans' doors from Amazon. All of those Chinese goods, really, on the other side of that, on the payment flows, it's the mirror image of physical supply chains, as I talked about. Those go through Hong Kong. And this idea that the dollar doesn't matter anymore, well, this, you'll see the obituaries written throughout the podcast media. It's even trickled into the mainstream financial media. You'll hear about this on CNBC. Really can't get away from it. If that were the case, then these developments in Hong Kong that we've been seeing might be playing out differently. But to go into what happened in Hong Kong over the last week, on May 2nd, the Hong Kong dollar, which is pegged in a range of 7.75 to 7.85 against the US dollar, and it's been operated that way for decades. As Southeast Asian trade with the rest of the world has really ramped up in the post 1970s environment. That dollar peg from time to time will hit one side or one of those bands on the top or bottom, and the Hong Kong Monetary Authority will come in to support the peg from one side or the other. So in this case, the peg was hitting the bottom of the range, the 7.75, which means your Hong Kong dollar is getting too strong. And I'll describe what that means in a little bit. But when that happens, they don't want to see the Hong Kong dollar. When I say they, the financial institutions, as well as the regulators of the financial system within the city of Hong Kong. They don't want to see the Hong Kong dollar strengthen further against the US dollar. So what do? They, to support the peg, to keep it at 7.75, they actually have to sell Hong Kong dollars into the financial system and buy US dollars, right? We'll get into that in a second. Why would they do that? There's a rush for Hong Kong dollars. Now, on the other side of that, this week you saw the interest rate on those Hong Kong dollars that all these financial institutions park with the Hong Kong Monetary Authority. That the overnight lending rates just plummeted precipitously. and the that interest rate is known as the HIBOR, the Hong Kong Interbank Offering Rate. Same, similar moniker to the now defunct LIBOR, and it operates much in the same way. So for those of you who have been following the overnight funding mechanisms in dollars, and this HIBOR is really, it's onto a pegged currency dollar. So it's the same thing. It's an interest rate to borrow dollars. And at this point, I'd call it this one of the top two or three most important in the world. This is where the Southeast Asian, you know, financial hub, all of that trade flowing through Southeast Asia goes to access dollars and comes to trade. It's your central bazaar. Notably with Singapore, Tokyo, Shanghai's important, Sydney, et cetera. But Hong Kong is kind of broadly recognized as a key one. It's your gateway to mainland China from the rest of the world's perspective, from a financial channel. So those two things in tandem were the developments we saw today. I'll just go into really quick what this looked like on the exchange rate side. You'll see this on I called it the fire alarm flagging. Hong Kong dollar is getting stronger. What does that mean? Your banks in Hong Kong who trade or settle with each other as counterparties in the Hong Kong dollar are experiencing a flight to get more Hong Kong dollars, right? The HKD is not broadly held. It's not something traditionally used or owned in the rest of the world. American banks, European banks, they may hold some of them, but it's not broadly treated as the reserve currency. The peg is there really to keep things running smoothly within the Hong Kong financial center itself, and then its role it plays as kind of a gateway hub between rest of world and China, as I'd mentioned. So when the Hong Kong dollar strengthens and you see like, oh, it's a flight to quality, right? That's true, but only so much, to say as far as like within the large banks that operate and do most of the merchant banking and transactions to facilitate trade finance within Southeast Asia. So those banks will be your household names. You've seen their commercials. You see them on billboards. HSBC, Standard Charter in UK is big there. There's a few Chinese who have, and those are the UK banks, those two I mentioned. Chinese banks, you've got Bank of China, which is different than the rest of our banks. It's a state-owned SOE bank, but it's not their central bank, right? The PBOC, People's Bank of China, is their central bank. It's not different moniker than Bank of England or some of those where you would confuse that with a nation-state central bank. And then the U.S. banks are heavily involved there. So Citibank, JP Morgan, Bank of America, all of the big players are operating in the city of Hong Kong, and they all have to transact with each other as counterparties. So keep that in the back of your mind. That's a key detail in what's going on in this overall story. Now, what you saw on Monday and Tuesday of this week, as the story continues to develop, I mentioned there's a massive demand for these large financial institutions to hold Hong Kong dollars. The chart to track the balances of these financial institutions that they park with the Hong Kong Monetary Authority, that time series is reported under this series under this data print called the aggregate balance, right? What does that mean? Well, it's the aggregate of all of these authorized, large money center banks. It's essentially like, if you think about from a U.S. markets perspective, it's an equivalent of your reserves parked at the Fed, right? What's the point of reserves? You'll hear some, widely kind of followed commentators on financial Twitter, podcast scene, all of that say reserves don't matter. They're worth not like QE is an inflation, that whole talk. Reserves are important in the transaction settlement between banks and financial institutions, right? Why do you need reserves? Well, if you don't have them and you get hit with an outflow and you have to pay off another financial institutions, if you don't have those balances parked at, well, in the US case it'd be at the Fed, but in Hong Kong's case, say it's the Hong Kong Monetary Authority, and your reserve or your balance parked, that goes into that aggregate balance total. If you don't have those numbers to meet a counterparty kind of settlement, you failed. You fail the trade, you fail a transaction, you're no longer seen as a good counterparty, all of that. So what's happening is you see these banks and financial institutions inside the city of Hong Kong rushing to get more, to load up on liquidity for that potential. You want to make sure you can meet your obligations, your liabilities that you've signed up for. So what you do is you kind of rush into that liquidity and reserves. So when we say there's a flight to quality globally, you see this happening in other currencies, Swiss franc, Europe, rallying against the dollar. The Hong Kong dollar is particularly important in my mind. It's the one to watch because it's your trade test between the US and China. So what happened in the last month with Liberation Day going into effect? You see all of these reports that US port activity, especially on the West Coast, you follow here in Seattle, there's been numerous photos of and just aerial shots of the just slowdown in port traffic. Someone call it crickets, might be a good word for it, as you would expect, right? When these tariffs just got put on, in particular on China. So the counter side of that means because there are no shipping containers getting unloaded on the West Coast of the US or everywhere, East Coast as well, means the banks in Hong Kong that the Chinese exports were receiving dollars on the financial side of those transactions. There's no US dollars. The dollar flow has been turned down, as we've been describing on prior episodes. So this rush into the Hong Kong dollar to kind of provide a ballast against that kind of liquidity need that these banks all see coming. That's exactly what this is. So you rush into the Hong Kong dollar, you hit the strong side of the peg, and what actually ends up happening is your Hong Kong Monetary Authority, instead of the peg breaking on the weakening end, which is what a lot of the frameworks, popularized in the post-2008 environment, calling for a break in the HKD peg, they probably saw it breaking on the weakening side. They wouldn't be able to support it. Well, in this case, what actually happened, how it mechanically is playing out, the dollar flows turn off all of a sudden now. In the short run, you get the banks rushing in to the Hong Kong dollar to meet their liability, so they know they can settle and make it through this next phase, what's ahead. Now, what is ahead, right? This is officially, to go back into 2008, if anybody was around those days, you had Chuck Prince, the CEO of Citigroup, come up with this quote that's really stood as one of the top 10 to 20 memorable quotes out of a lot of them. I'd say maybe number one is Ben Bernanke. So we think subprime is contained, right? 2007, right before the show just went south quick. Chuck Prince, I think it was late 2007, came up with a quote. And it was on an earnings call, I believe. It could have just been to a reporter in the press, where he's talking about this idea that in the credit system, while the music is playing, you have to stay up and dance. And he specifically said, we're still dancing, like the music is still playing. Well, it turned out he was dead wrong. It was not dancing anymore. The music had stopped. It was time to get out, but he was too late. So what happens? What do we mean when the music has stopped, right? Well, it means you're in the slowdown phase in the credit cycle. Economic activity is slowing down. Credit creation is um, tapering off, like in the private economy. Uh, Households, governments, businesses are running into more trouble, more difficulty servicing their existing dollar debt. And ultimately, something materializes at the base levels of the dollar system to signal, hey, this is like music in this game of musical chairs has stopped. The chairs had been pulled away while everybody was dancing, and now everybody has to scramble to try to find a chair to sit into. That's what we're talking about here. So this whole scramble, the music has stopped. Everybody's got to now rush into the Hong Kong dollar and present to themselves and their counterparties that they can meet all of their IOUs, their obligations. If you can't meet your IOUs, well, you can go to a regulator, you can tap a window, try to get financing, or in the worst case, you could see a failure of a financial institution, or some credits fail, default, etc. But that's generally how you see these environments playing out. So what I've got here on split screen top and bottom,
The SOFR,
I'm
you got HIHDO /N index on the top, and then HO8. It's the same thing dash
yeah,
SOFR index on the bottom.
okay. So I've got SOFR on the top, and SOFR only goes back to 2018. This is a key piece we put in the overnight financing mechanism. So the U.S. Um, not so quietly, this would be one of your most important hallmarks in understanding what's going on in the U.S. dollar, but also credit as we go into the post 2020 kind of world. SOFR has taken over, but as a general overnight financing rate. But the key thing is it has to be collateralized. Yeah, to post a U.S. Treasury IOU, it's turtles all the way down. There's no hard money, but it's a harder borrowing standard than what had pre-existed, which was LIBOR, which is really just an interest rate set on no market forces. It's just set on a survey of financial institutions. So for the red line, I've got SOFR as far back as it will go. And then for a comp, because I want to provide a comp so we can understand where the dollar cycle has been in prior iterations, I've got the just the general collateral rate, right? And that's a time series that has a much longer history, but it's not. It was kind of just a precursor to SOFR. It's tri-party repo transactions, which mean you got borrower, lender, and a trusted third party in the middle, and it's a secured borrowing rate, but it's different than this whole SOFR mechanism, which has been set up and implemented going back to 2018. And on the bottom, I've got the HIBOR, the Hong Kong Interbank Offering Rate, which has a long history as well for overnight financing, repo borrowing in dollars, which is an interest rate that is not secured. It's just a reference rate. It's what banks will charge other counterparties, but it's not really a market-based transaction. And the way it's set is all loosey-goosey. It's survey implemented, right? So it's got the same problems that LIBOR had. And if you think about the setup, why do LIBOR and HIBOR look so similar? They're like brothers from the same mother. It's because City of London, the London banks, they really created the franchise in the Hong Kong financial system, right? Hong Kong was a British, I don't know if you call it a colony, but it was a British port, and it operated under the UK flag up until the late 1990s, when you had a handover from the UK to mainland China to operate or to govern the city of Hong Kong. But what you see over time, those spreads between those two rates, right? Well, The HIBOR is the rate to borrow Hong Kong dollars, right? But those are pegged to the dollar, right? So you see that it's really the dollar driving the show at the base level. But the HIBOR is how the banks who are kind of financing merchant trade, from China and Southeast Asia to the rest of the world. The HIBOR is the rate that really governs those flows and that economic activity, right? And so what you see, the prior slowdowns when the dollar cycle is starting to trough, every time going back to the 2019 and 2020 episode, or even the 2007, 2008 episode, what you see is HIBOR, the opposite of a spike, HIBOR to SOFR spread, or the HIBOR to the general collateral rate spread, because we don't have a SOFR rate. It didn't exist back in 2008. What you see is that the HIBOR rate drop, or in 2018 or 2019, what we saw the opposite was SOFR actually spiked. And this time around, we saw similar to the 2008 episode, where it's actually HIBOR where the pressure materializes in the overnight dollar funding system. And you see the spread between the U.S. financing rate and Southeast Asian dollar financing rate through Hong Kong go massively negative, and that's your sign that there's an extreme pressure in the dollar system. So what's going on here in Hong Kong and the tariff story, Liberation Day? Liberation Day really kicked off by closing off the dollar flows, the no imports coming into the US, essentially, no dollars flowing into Southeast Asia. Hong Kong has now, it's created a run on liquidity within the financial center of Hong Kong. So all these stories you see, they are very tightly woven and connected. And if it were the case that the world was fleeing the dollar, this whole de-dollarization narrative, you wouldn't necessarily expect to see something so important kind of emerging, causally from, Trump's actions in the White House putting the tariffs. Why do they matter? Well, it's because of the pressure that decision on Liberation Day put on other countries and finance economies, as well as the sovereign debt. So to just go into this a little bit further, when we to really drill home the report, this is the Mark Twain quote: "The reports of my death are greatly exaggerated." This is when like a telegraph or a news outlet just started, or like just a rumor caught wind, and eventually his obituaries wound up on the front page. And Mark Twain had not really passed away yet. Same thing, I think this applies to the dollar in this case. Why? Well, if the dollar were being given up as a global financing source of capital, you wouldn't expect to see a lot of the behavior that's actually materializing. So to go on Bloomberg, and I sourced this data myself, just going through all of the bond offerings issued that you can go through in the Bloomberg catalog. This is a series of US dollar denominated debt that's been issued by governments and private borrowers, so corporates mainly, on a quarterly basis, that's coming out of the Hong Kong domicile, right? So it's US dollar debt, but it's coming from the port of Hong Kong. And what you've seen since 2008, and part of this is just not cataloging, right? A lot of these bonds are opaque and not visible to the rest of the global financial system, or they may be dollar bonds that aren't even invested in or held by players in the U.S. economy, or in the domestic U.S. economy. But what you've seen since 2008, it's a very clear up and to the right trend that Hong Kong banks and financials, governments themselves, and then I call it other, but this is industry. It's special purpose vehicles, industrials, um, infrastructure, transportation, railways, all of that. It's actually the opposite of the de-dollarization narrative. Hong Kong is more reliant. They're creating more dollar debt to capitalize and fund whatever it is they're doing, and I'll get into that. They're becoming more reliant on dollar debt. So you can see this chart, and it's peaked last quarter. Q1 was actually the largest dollar debt issuance that shows up in the entirety of this Bloomberg or debt catalog. In Q2, then this is through this week, we're 5 weeks, 6 weeks into Q2. We still got 7 to go, right? Till we get to the end of June. There's already been over $20 billion of US dollar debt issued in Hong Kong, right? So when you issue a bond, what are you doing? You're issuing an IOU to get dollars back or the currency back, a bank deposit back. And so what this is telling you is Hong Kong needs dollars. It's pulling in dollars. And the reason why, if you look on the other side, what is the main initiative since 2013, 2014, from the Chinese government's perspective? Exactly, it's Belt and Road. What is Belt and Road? It's physical infrastructure projects and development into the rest of the world to essentially grow out the trade base, right? So it's ports, infrastructure, railway, etc., all of the above. But it's actually these offshore dollars are the Belt and Road Initiative. They're one and the same thing, right? And so by creating this dollar squeeze through the tariffs, what the US has done is put a pause on that whole situation, right? And this creates, from a negotiating standpoint, right, art of the deal. What is Trump, everything talking about right now from the White House? We're working on deals. This ends when some sort of deal is struck, right? And there's very clear things from the US perspective we want out of a deal. Taking over control of Panama Canal is, in my opinion, what looks to be number one, right? Right now, the Panama Canal port operator sits under a Hong Kong company named CK Hutchinson. There was an agreement to sell, right, or transfer ownership to BlackRock 5-6 weeks ago. That's been pulled back under kind of a headline from Xi, where he mentioned, no, we intended to use that as a trade chip, right? That is part of the trade negotiation. When I say trade, it is literally trade, but it's also horse trading, who gets what. So we know what the U.S. wants out of this deal. Part of it too is going to be same way that LIBOR was pulled back and retired and replaced with SOFR. It could be more controlled by the domestic financial system. You know, those large U.S. banks that are already operating in Hong Kong. But I think the other thing you would like to see from the U.S. perspective is more market share in terms of the dollar trade within the port of Hong Kong itself, right? Who loses here, right? Because the Chinese sponsored banks, they're not leaving, right? Bank of China, Bank of East Asia, et cetera, they're going to be in the game. So they're going to have market share as well. Who loses? It's got to be the UK banks and the European banks. So HSBC, Standard Charter, those names, look for those. Like, that's where the actual conflict is. And then when you mirror it, the same time, what did you hear today? The big launch, Trump's first mini deal of a trade deal with the UK. So all of these are negotiations to get down, at the nation state level, get down to brass tacks and find out what's the new kind of steady state agreement where we can continue business as usual. So what's actually happening, you see these Trump tweets, right? Trump is playing. This is in my case. I tweeted this morning. When Trump says Powell's a dummy, he needs to cut rates. At this point, he's saying at least he likes the guy. Right? They're very clearly on the same side of the negotiation table. But this may be, in my opinion, the most obvious but also effective case of good cop, bad cop negotiations that we've ever seen at the largest stakes, right? So, why does the US want to keep short term interest rates high for now within the domestic economy? What is actually happening is, say, the SOFR rate in the US or the Fed funds rate or the 1 month T bill rate, that's at, let's say, 4.25 to 4.5 today versus HIBOR just plummeted down below 3. And I'm looking, I had to zoom in because I'm operating at like a quarter of my screen on this podcast setup we're on. But that fell sub 3, 2.5. So what's happening is the financial system, global capital, has to find the highest and best return, right? So for overnight money, you're choosing as a global money center, do I want to park this with the Fed? I can park my cash at the reverse repo facility, or I can buy a T-bill, or I can lend it out in the Hong Kong financial system at, let's say, 2.5% in HIBOR, or lend to SOFR, 4.25, 4.5. So those dollars will move, right? And they'll go find the higher rate. So what that negative HIBOR SOFR spread is doing is it's actually pulling in the flow of dollars from the offshore into the US, right? And then on the other side of that, the HKMA is also pulling in, when they sell HKD to provide liquidity into the interbank market, they're also buying dollars, but then they have to find somewhere to deploy them as well, right? The US dollars. And so they might actually be, I don't know exactly how their overnight operations work or what they do with their cash, but they could just as well with those US dollars lend it in to the US domestic economy or financial system if they were permitted to. So now I'm not quite sure if they can, but they've got to hold something, right? They'll probably buy a treasury, something like that. All right. So the dollars come in onshore, right? You've got dollar flows now instead of the other direction for 40 years, right? Where dollars just were shipped outside the US and we were just, bleeding flows. Now those dollars are rushing back into the domestic economy. And so what you should see, right? It starts with your large money center banks, so your JP Morgan, Citibank, et cetera. You should start to see this show up as an asset on their balance sheets. And this is where the Fed series, the H.8 reports, survey of all US commercial banks, they even break it out by the large commercial banks. We'll finally start to see this about maybe next week's release. It's a 2 week delayed report. So this should start showing up on the US banks balance sheets. It's already happening, over the last 7 days since we saw this activity in Hong Kong. But this will continue to develop. So what's happening? You get a bunch of dollars hitting the US economy. That works its way through the credit system. And then it ultimately works out into financial asset prices. So liquidity increases, flows increases, and this is impacting like levels downstream from this, stock prices, risk assets, credit creation, and Bitcoin, right? As you see those flows really start to pick up. So that's the Hong Kong dollar. Any questions there? But this is one of those things, especially an American audience, you can let this one gloss over, but this is a very important development going on.